How small apartment investors can calculate and compare depreciation deductions. Determine the cost basis and allocate land value. Identify the depreciable basis by subtracting the land value from the property's purchase price to determine the depreciable basis. For example, if the property is purchased for $1 million and the land is valued at $200,000, the depreciable basis is $800,000. Verify asset classification. Confirm the property qualifies as residential with a useful life of 27.5 years. Depreciation schedules vary depending on property type and asset classification. Calculate straight-line depreciation. Divide by useful life. Use the straight-line method for standard residential properties, dividing the cost basis by 27.5 years. This provides a steady annual deduction that investors can rely on each year. Estimate annual tax savings by multiplying the depreciation deduction by the investor's tax rate to get an idea of the annual tax savings from depreciation. Evaluate accelerated depreciation and cost segregation by conducting a cost segregation study. For larger properties, consider breaking down the property into shorter-lived components that are eligible for accelerated depreciation. Calculate accelerated deductions by assigning shorter useful lives to components like appliances, carpet, and landscaping to increase early-year deductions. For example, a $100,000 component with a 5-year life offers $20,000 in annual deductions, significantly higher than the standard straight-line rate. Compare savings over time. Calculate the tax savings for each method, straight-line, accelerated, and cost segregation, over the property's holding period. Early deductions increase cash flow, but may reduce total deductions later, so choose the strategy that aligns with your investment goals. Adjust for special depreciation allowances, if applicable. Bonus depreciation. For certain property components, consider bonus depreciation, which allows immediate deduction of a large percentage of the asset cost in the year it's placed in service. Section 179, Expensing. Under Section 179, investors can deduct the full cost of qualifying assets, such as equipment, in the year of purchase. This offers an immediate tax benefit. Consult with a tax professional to assess the best depreciation strategy. Work with a tax advisor to determine the most beneficial approach based on the property's characteristics, the investor's tax bracket, and cash flow goals. Plan for recapture. Understand that when the property is sold, the IRS requires depreciation, recapture tax on the amount deducted over time. Consulting a tax advisor helps investors plan for this eventuality and strategize around the impact. Additional tips for leveraging depreciation deductions. Keep detailed records. Maintain records of purchase price, land allocation, and all improvements for accurate depreciation calculations and future tax planning. Review depreciation annually. Update depreciation schedules as new assets are added or improvements are made to ensure deductions reflect current property value. Plan for depreciation. Recapture. Prepare for depreciation. Recapture tax upon property sale, which recaptures the tax benefits received through depreciation deductions. Summary. Depreciation deductions are a valuable tool for reducing taxable income and improving cash flow in apartment investing. By understanding straight-line depreciation, accelerated depreciation, and cost segregation, small apartment investors can choose the most effective strategy for their property. With proper planning and guidance from a tax professional, investors can maximize tax savings, leverage early-year deductions, and optimize overall returns, enhancing the financial success of their apartment investment.